What's up, deal makers? In this video, we're going to talk about Alphabet, one of the FANG stocks, or more popularly known as Google. We're going to look at their latest earnings report, and I'm going to share what I found with you guys so you can make an informed decision if you want to buy or add Google to your portfolio or not. So let's dive in. Here is a quick overview of what we will discuss. We'll go over Google's business first, then run through 5 reasons not to buy Alphabet and 8 reasons why you should still consider buying Alphabet. In the end, it's up to you to decide. This is not investment advice, and I'm not a licensed investment advisor. I'm just a random guy on YouTube sharing my personal investment research. So let's begin. This is the structure of Alphabet. There are 2 branches. So the first branch is Google. This is the biggest branch of Alphabet, accounting for 99.5% of revenue. Alphabet also has all of these other bets. They're not yet money making or they're not yet profitable, and it's led by Google X, their super secretive research and development unit. Now, these are all long shot attempts to solve impossible problems that hopefully will uncover Google's next big business opportunity. Google is still the world's most dominant search engine. And under Google, you have other brands like Google Ads, Google Cloud, G Suite, YouTube, Android, and others under the Google umbrella. So, how did Google perform in 2020? Well, there are 5 things that you might want to consider to avoid Alphabet. These are reasons why you might not want to buy Alphabet. Number one, hedge funds are selling. And a very, very close number two is insiders are selling. Corporate insiders are selling. So we're here at Google's research tab inside Etoro. As you can see, the trend for the last quarter, the Q4 of 2020, is that hedge funds decreased their holdings by more than 300,000 shares. You can see the constant drop in ownership by hedge funds, and the hedge fund sentiment meter here points towards the negative. There's negative sentiment when it comes to hedge fund ownership. We can also see what are the latest actions by hedge funds. John Gunn reduced his reduced their position at Dodge and Cox by 10.51%, or that's about 4 billion. Boykin Curry of Eagle Capital Management reduced it by 5%, that's around 2 billion. And PrimeCap Management reduced their holdings by 17.4%, or about 1.8 billion. And a few more here. We have a couple who have reduced Chris Davis by 1.2 billion. John Armitage of Egerton Capital added 85.64%. That's about 1.1 billion. David Blood also reduced. Garner and Russo, Farallon Capital, First Eagle Management. So as you can see here, these are already smaller positions. So in general, hedge funds were reducing their positions in Google in the last quarter. Down here, we have insider transactions. Corporate insiders sold shares worth more than 24.7 million in the last quarter. So you can see the sentiment meter. Again, also it's very negative. There are more corporate insiders selling their shares instead of accumulating more shares. So those two signals are things, so those two are negative signals against owning Google. But of course, those are not the only 2 things that we will consider. So let's look at number 3. Google Cloud, supposedly one of the more promising projects of Google, is still unprofitable. So looking at the operating losses inside Google Cloud, so you can see that it's been increasing since 2018. Instead of becoming more profitable, it is actually losing more money, likely because it is trying to grow the business. So from a little over 4 billion by 2020 It's almost $6 billion in losses for Google Cloud. Number four, Google's other bets are also unprofitable. Like I mentioned earlier, Google is the sole source of revenue. Well, this is the majority source of revenue for Alphabet, accounting for 99.5% of their revenue. All the other bets are still unprofitable. You can see here 2018, a little over 3 billion in losses. 2019, almost 5 billion in losses. And 2020, that's almost 4.4 or 4.5 billion in losses for Google's other bets. But we can see here, hopefully this is already a kind of a turnaround. It's an improvement, and we can start seeing at least one or two or even more of Google's other bets, making more money for Google. And the fifth reason, to possibly avoid buying Google is now there are threats to Google advertising's revenue. There are rising threats to Google advertising's revenue. First is Apple's iOS 14 update. They're going to make it easier for users to turn on their privacy settings. It's going to be harder for advertisers to use behavior tracking technology. And Google and Facebook use these technology to personalize the ad experience. And as you can see here, Google will stop collecting IDFAs, that is the technical term for the set of information that Google collects to identify user behavior. And Google already said that app developers will see a significant impact to their Google ad revenue. So if app developers are impacted, then definitely Google will also be impacted because Google ad revenues are operated on a sharing basis. Another threat to Google's revenue stream is Australia's decision to force Google and other big tech companies to pay for news. So Google will now pay news organizations in Australia because of recent legislation requiring the tech giants to compensate news agencies for content. If this happens in Australia, the question is, will other countries follow and will Google bow to them? Google can probably afford it, but right now we don't know how big the exact impact will be. You can see later that Google's revenue is still high and they have huge cash balances that can help them. But even with those red flags, there are still 9 reasons why it's still a good idea to buy Google. So let's look at those 9 reasons. Number one, revenue is still growing at a solid 23%. So you can see from this chart, revenue is still growing like a startup for Google ever since 2016 and up to 2020. Google has been rising steadily. In 2020, it rose by 23% from the previous year. Google also has high operating margins. The operating margin for Google is at 27.5%. Google's total revenue in 2020 sat at 182 billion, and total operating income for Google is 41.22 billion dollars. Number three reason, net earnings is still growing. So there was a slight hiccup in 2017, but overall the trajectory for net earnings in Google is still positive, growing 17.2% in 2020. So these are still healthy revenue and earnings growth numbers, even for a company as large as Google. And that has translated well on their stock chart. So you can see here that after Google's earnings were announced in February 2, you can see the jump up in Google's price. Number four, Google has an extremely solid economic moat. Google still owns a very, very large portion of the market share for search, sitting at 85.86% in January of 2021. So Bing is a far second at 6.84%. When it comes to search traffic, Google is still the undisputed number one. When it comes to mobile internet traffic, YouTube is responsible for 37% of all traffic. So there's a lot to like about Google. So smash that like button for the YouTube algorithm if you want to keep hearing good company news like this. This helps the channel grow and it helps me make more videos like this. Moving on, Google has very low levels of debt. They have a current ratio of 3.05. And even if we just take their cash and cash equivalents, so they're sitting at $136.7 billion in cash and cash equivalents. To put that in perspective, Starbucks has a market cap of $121.7 billion. Google can buy Starbucks in cash if they wanted to. But of course, they probably won't do that. Their current liabilities sit at 56.8 billion. Their cash levels is more than adequate to pay for their current liabilities. Even their long-term debt is very low. The debt to equity ratio sits at 0.12%, and their long-term debt sits at 13.9 billion. Google can easily pay that off. Maybe Google owes a few investment banks a favor, so they're keeping this long-term debt alive. They, but the truth is they don't need to run any debt. Number six, there is still strong growth. Yeah. Number six, growth in Google is being driven by strong growth in YouTube and Google Cloud. So even though Google Cloud is still unprofitable, it's driving a lot of the growth inside Google. As we can see here, YouTube ads are growing at a faster pace than Google ads in general. YouTube ads are growing at a faster pace than Google's total revenue. So in 2020, YouTube ads revenue went up by 30.5% at $19.7 billion. Google Cloud's revenue went up by 46.4%, sitting at $13.1 billion in 2020. So the strong growth in Google Cloud gives hope that it will eventually become profitable. So that is my hope also. In addition to that, there are now a few very promising bets. Top of the list is Waymo. Waymo is getting more attention with the rise of Tesla. Waymo has actually been operating a pilot robo-taxi service already in Arizona, and they just got approval to start testing in San Francisco. And if you watched my GM stock analysis, GM is also doing the same in San Francisco. So we're going to have a little competition here when it comes to robo-taxis in San Francisco. Waymo is actually leading in the robo-taxi race compared to Tesla. But obviously, Tesla has more self-driving cars already on the road, and they're getting more data than Waymo when it comes to autonomous driving. So it remains to be seen who will become the eventual leader, but it remains to be seen who will become the eventual leader, but it's good to see the Waymo beginning robo-taxi tests in more locations. Another promising bet is DeepMind. DeepMind is making a lot of advances in machine learning and medical research. They are poised to benefit from demand in AI medicine software market. So there's going to be a booming demand for AI medicine software. In addition to that, DeepMind has solved a 50-year-old grand challenge in biology, protein folding. Apparently, protein folding is more complicated than DNA folding, and that has been a very big problem for the past 50 years in biological research. Not only that, DeepMind is helping doctors diagnose acute kidney injury, and they're helping identify breast cancer more accurately. And finally, reason number eight, Alphabet has a strong buy rating from Wall Street. All right, so you can see here that there is 100% consensus among Google's 9 analysts. So they all give a strong buy rating for Alphabet with a median price target of $2,330.63. That is a 10.92% median upside with the highest estimate at $2,750. So there's a lot of upside still for Alphabet, and that is one of the strongest buy signals. So there's definitely a lot of things to like about Google as a company and as a stock, and I would also like you to smash the like button for the YouTube algorithm. Make sure to make that button turn blue. So it's an easy yes. Yes, you should buy Alphabet stock now if you want to have a solid growth stock in your portfolio. Up next, we'll be talking about Roku, Carvana, and a mystery fintech stock. So this fintech stock is something that I'm really, really excited about. I've been hearing this stock for quite some time, and I'm going to be doing a I'm going to be doing a deep dive on this stock very, very soon. So I hope that you will stay tuned for that because unlike these other stocks like Alphabet, Google, Microsoft, now these are all big stocks already, but this next stock, after Roku and Carvana, is going to be a rather small company that still has a lot of exciting upside. If you like what you've heard and if you'd like to hear more, please make sure to subscribe to this channel and hit the notification bell so that you'll be notified whenever there are new videos like this. And if you want more stock analysis videos like this one, make sure to check out the 2021 Best Stocks to Buy playlist. I hope you stick around in this channel and I hope that you make more deals in the stock market. And I will see you in the next video.